Selling insurance is hard as a mortgage broker. Insurance, protection, whatever it may be, it is a hard thing to do. That's what I want to unpack in today's episode. I want to talk about some techniques, some tips, some tricks that I have helped many other advisors sell more insurance. I've been able to not only help build some of the careers of some of the best sales coaches out there and build their branding, such as people like Matt Chapman and Gary Waters, but I've also been able to coach my own clients through increasing their own protection. Some of these people are 2, 3, 4xing their income through insurance sales. I'm going to share tips and tricks that I use with my clients when it comes to increasing their insurance deals. The very first one we're going to be talking about today is introducing insurance right at the start and integrating it into the full mortgage process. So right from the beginning, one of the biggest mistakes I see mortgage advisors, mortgage brokers make is that they do not talk about insurance right from the get-go. They often will maybe talk about it much later on. If you're somebody who does this, you do the mortgage first, you talk about that, you deal with that first, and then the mortgage is offered and you just happen then to bring it in. That is way too late. But really, what you need to do is you need to introduce insurance right at the start. In the first initial discovery call, insurance needs to be there and it needs to be integrated into the mortgage process. There has to be clear in the client's mind that there is no difference between the insurance and the mortgage, because the truth is there isn't. This is a false line that we've put in our head that insurance and mortgages are separate parts of the process. They're not. And in fact, when I work with my clients, we refer to this as the mortgage package. We tell the client that in the industry, your mortgage package is broken up into 3 areas. That is your monthly mortgage payment, your buildings and contents insurance, and also your personal protection. Those are the 3 parts of your monthly mortgage package, and that is how much money you'll be paying every single month in order to own a home. Creating a cohesive kind of package for the client so they understand that there's no difference between one and the other helps you instantly, and also bringing it into that discovery call when we're first having that initial call is going to make it so much easier for you to sell insurance, because later on when you start to actually talk to them and pitch it to them and get them to agree to the products they're going to take, then you're already off to the races. The second tip is do not overcomplicate. The thing I see many advisors do is we go down and we talk about everything to do with insurance. We might over egg the souffle, so to speak, at the beginning. We might start to talk about all of the features and the benefits. And this is why Vitality, in my opinion, can be a bit of a minefield unless you know how to do it well. I have clients of mine, advisors, who are very good at Vitality, but you have to be very skilled to get it done right. If you overcomplicate, especially at the beginning, you will make them run a mile. Remember that the products sell themselves. You don't have to sell them. And I think that's something that people make mistakes. Go through. It literally is life insurance pays if you were to die. Critical illness pays if you get critically ill. Income protection pays if you're unable to work, and it gives you income. Really that straightforward. The less is more approach is going to help you win. If you start to over explain, people will clock out. They're not a fan of it and you'll lose them. So pro tip on this, you want to do this with all of the things within your entire mortgage process. If you're somebody that prides yourself on going deep into subjects and really sharing that with them, I'm going to tell you right now, that's not actually a good thing. And I was that guy. That's why I'm happy to say that. I was that guy who would sit down and I would go, look, let me tell you about everything. You need to know what 5-year fix is, variable rate is, different things. You don't want to do that. Your job is people are coming to you because they want you to guide them through the situation. Take the complex and make it simple for them to understand. Best time to bring in those added benefits is once they've agreed to the product. If they've agreed to the fact that what it actually does is clears the mortgage and does those type of things, and they've said yes and they're happy with the price, well, guess what then? Those features, those benefits of the product, they now become extra things that just make it so much better now they've already agreed to it. Don't get stuck in thinking that those are the things that sell it. No one buys insurance for a free Apple Watch and a free Starbucks coffee. Don't fall into that trap. The next one we have is, well, we've been watching Cobra Kai recently, and we're going to say, budget is banned in this dojo. We'll say that. The term budget, asking for a client's budget, do not do this. By the way, I am not a fan of this across the board. I know that some of you have to do this for compliance reasons. It's a stupid thing to ask from a compliance perspective. Budget is the dumbest thing I've ever heard. Why is budget dumb? Let me explain. Budget is what you want to pay, not what you will pay. So when you ask someone, what's your budget? Well, guess what? I want full cover. I want full life, full kit, full IP, and I only want to spend £10 a month. That's the budget. That's what I want to pay, not what I'm willing to pay. And it's exactly the same thing with mortgages, by the way. When they say, what's your monthly budget? Well, it's funny how they'll say, oh, don't want to pay more than about £1,000. Then they find a house and it's going to cost them £1,500, £1,800. Oh, now they seem to find more budget. It's a stupid thing to get sucked into. So instead, just avoid budget altogether. Avoid it altogether. Don't even bring it up. You just avoid it altogether. Which leads me into the next one, which is price anchoring. So price anchoring is effectively taking something and making it the thing that the client associates as price. There is a better definition. I'm sure I'll put it on screen right now, but price anchoring is a very valuable sales skill, and it's very important. It's effectively setting the stage for what they compare prices to. We used to do this a lot when I was at Connells, where we would do a cost of moving analysis, and we would do all of the cost to move a house, or your stamp duties, or your solicitor's fees, and then we would put our fees in there, and our fees were always significantly cheaper, and that's because it was price anchored to everything else. Price anchoring is something we're going to do an initial call to establish the budget, but it's not a budget. It's establish what reasonable cover should look like. Now, most people will do price anchoring in a number of ways. I'm going to tell you what I think you should do, but I'm going to say what many people do. Bad price anchoring is asking for the client's budget because you're letting the client anchor the price. One tier up from that is that using something like pet insurance, home insurance, car insurance, any general insurances, they're really bad price anchors. So you pay this much to look after your dog. It's a bad one to do. The next one above from that, which is one I quite like, but there's a better one. We'll talk about that one in a minute. But the next one above that is anchoring to around 10% of the mortgage payment. So what you're doing is you're anchoring to how much the mortgage would be. So you're saying, let's say the mortgage is £1,000. They're thinking, oh, it's £100 because you're anchoring to this 10% of the mortgage payment. Quite a lot of people do this. This is taught by many people within the industry. It was what I actually did when I was an advisor. I did this one, and you're able to get those good £100 to £150 a month premiums by doing this. But it's not the best one to do. The best one to do, by far, is anchoring to a percentage of your income. So anchoring to a percentage of your income, I normally say about 5%. When I work with my clients, about 5% of your income is what you would put aside. Now, why is this important? Well, because your income is what is used for your entire lifestyle. And this, by the way, is how some of my clients have been able to get £750, £800 a month premiums because the clients they work with are high net worth, and that was around 5% of their income. And so because of that, they get these bigger policies. So what happens is they don't let their own internal decision of whether or not that's affordable or not. To them, they use income as an anchor. If it's only 5% of their income, it makes it seem more affordable. It is such a great way of doing it, and using something like a financial resilience check, something that I do a lot with my clients. Matt Chapman also does this with his clients. Matt's been a client of mine for many years. I love that guy to pieces, and we work very closely on a lot of this stuff. It is a great way of doing it. So anchor to income, anchor to a percentage of your income, and establish this in the discovery call. This is what everybody does. Most people take around 5% of their income. Then this leads me to my next point, which is always pitch the full solution, the full amount to effectively eliminate all financial risk for the client. And when you pitch this, state to the client that your recommendation, this is important, that your recommendation is to take the full solution. If you know it is within the affordable of that 5% of their income, which you should know by this point because this will be done in a submission call, then you always want to make it that your recommendation is to take the full solution. Also, standardize within discovery calls and anytime you bring up insurance that the majority of your clients take the full solution. This is important to establish. The majority of people take the full solution. This is something that is crazy in this industry, is how many people ski downhill instantly, including myself when I was an advisor. We would do this thing of, well, not everybody takes it, and I'll work with you to find one that fits your the worst word budget, but we would do that. That's not what we're trying to do here. We want it to be clear that, yes, my advice as an advisor, as someone who's going to advise you financially, you should be taking the full solution. You have the available income, you have the actual problem, you have taken substantial debt when you take a mortgage. That means there is substantial risk. And by taking all these products, we can eliminate all of that financial risk. My recommendation is always going to be that. It is the stupidest thing when we think about it logically. If you said to somebody, so there's a cliff and there is a 10-meter gap, and you have a 10-meter piece of wood and you have a 9-meter piece of wood, and then for some reason, someone comes to us, if you go, oh yeah, you probably need a 10, but realistically, you don't need to have the 10. I think the 9 is going to be fine. You know that's dumb. They're going to put that out, they're going to fall off the cliff and die. That's exactly what's going to happen. And yet we do that here. You are leaving a shortfall which could be disastrous to their family, to their financial and economical situation. And because of this weird thing we do in our industry, we leave so many people with shortfalls. We wouldn't do that, so don't. You're not trying to be the pushy salesperson. You're being an advisor. If you all want to pride yourself on being an advisor, be an actual advisor. Advise the truth. Don't try and get what you can get. Tell them what they need. You need the 10-foot piece of wood across the bloody cavern. That's it. Anything else is not going to get there. It's not going to eliminate the risk. It might reduce risk, but it's not going to eliminate the risk. Make that very clear. People will act in line with, one, people of authority. So if you've established yourself as an authority, that will work. And two, they will also act in line with what other people do. If you say that everybody else doesn't take the full solution and you work with them and they take different cover, and that's fine, then they're not going to take it. But if you say everybody takes it, guess what? They will take it, or they'll be significantly more likely to take it. Now, when it comes to insurance, lead with income first. When you are presenting your insurance, the first thing to be presented and the last thing to go from your options that you offer should be income. Well, because income while you're alive and income while you're dead, so income protection and family income benefit, FIB, is the cornerstone. Without those things, I can't really do much. But with those things and nothing else, no life insurance, no critical illness cover, you'll be still okay. Income is everything. From there, you can then build out your DTA life and all that other stuff you want to do. That's fine. But income is the cornerstone. And it's income while you're alive, and just as importantly, income if you die. You need the two. A lump sum payout does not solve the family's problems. Remember that. Why is this important to talk about again? Is because you're trying to let the client see that you are actually giving real advice. You're thinking about the situation. You're not just trying to lug on with the policy and hope you run away to the bank and then hope it gets clawed. It will not get clawed back if you sell it correctly in the mindset of how these people will actually need it, which is income while they live, income once they're passed. Really straightforward. Which brings me to my final one with this one. And this is the final point we'll talk about in this episode. And that is submit all at the same time. You have a discovery call. You announce with the clients. You talk about what it is. You talk about the mortgage process. You integrate the mortgage package. You talk about the whole thing. And then your appointment after that is when they found a house, you do a submission call. And you should have all the medical information. You should have everything prepared. And you should submit the mortgage and the insurance off the back of that call. Always. Everything should go at once. It should be introduced as one and it should be left as one. And the reason why is, well, there's twofold. First reason is if the client doesn't see the difference between the mortgage and insurance, if we've pitched it correctly and positioned it correctly, they won't see the difference. So we need it to be like, this is just part of it. So you get medical questionnaires. Yes, you get your medical questions filled out. When they do fact finds, you do the same thing. Get yourself an independent medical questionnaire, get it filled out, accurate to as accurate can be, get it from them. You need to get information before you do that. This is a mortgage package. It all has to be submitted together. So they'll do it because that's what they assume is the case. And it should be the case. The second reason, however, is that if you stop doing that and you give them the mortgage, if you don't do that, for example, and you give them the mortgage first and then you do it afterwards, you have given them what they want. They will drop off a cliff, and some of them will come back, yes, but not all of them. If you give them what they want, they will no longer need you. And this is important. They will do anything you say whilst you still have the mortgage in your hands. And this is not manipulation. It's making sure that they get everything in order. It's your process. And yet so many people are so quick to rush to get the mortgage off their desk and then wonder why the clients disappear. Don't be that person. Now, if you enjoyed this episode, check out this other one where I got 10 mortgage advisors to give me their top tips, including selling insurance, taking on new clients, marketing themselves. They share all of it, and it is on this video right here. So give it a click.